Hey everybody, hope you are enjoying the sunshine here. I think it's supposed to be up in the 90s in Bellevue this weekend, so hope you're able to get outside and enjoy this warm weather. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal every Thursday is to bring to you the market news, data, trends we're watching, hopefully weed out a bit of the noise along the way. This week, we have some important stuff to cover. I mean, really, inflation and jobs are going to be the name of the game. It's going to be the headline. It's going to be the focus. It's going to be what the market trades on, along with maybe the debt ceiling, which I'll get to here in a little bit for our question of the week. But those numbers, jobs and inflation, are going to be extremely important, going to cause a lot of short-term volatility up or down, depending on how those numbers shake out. So we're going to talk a lot about jobs and inflation here this week, as you might expect. We also, again, will touch on our question of the week, which is all about the debt ceiling now that we're getting closer and closer. We've touched on this a long ways back, but we're going to come back to that and talk a little bit about, our perspective on what's going on there. So first off, let's talk about jobs. So going back to last week, we had non-farm payrolls come out on Friday, and it shows that we added 253,000 jobs. So a huge month in terms of jobs added. And from my perspective, another point to show that the Fed likely is not going to be worried about jobs at all as they figure out what's next, right? Again, for the mandates, jobs and inflation. Jobs are certainly looking good. Labor market certainly looks strong. So the Fed, I don't believe, really needs to factor that in. They haven't in the past. They probably won't moving forward. It's not something that's going to concern them in June, but inflation might. Now, last thing on jobs before we flip over to the CPI and PPI on this morning, initial jobless claims came out at 264,000. So to be fair, it's another tick up. And remember, non-farm payrolls looks at April. So keep that in mind. We've seen some tick ups now for quite a few weeks in a row. Where that continues, we will see. But nonetheless, for us to go from where we are now in terms of jobless claims and job openings and all that to a place where the Fed would be concerned, I think we got some room there. So it's really inflation that's going to be important. However, the market will react to jobs numbers still in the coming month here. All right, so let's talk about inflation. Let's fast forward to just yesterday, Wednesday. We had CPI numbers come out, Consumer Price Index, and basically both CPI and core CPI were at 0.4%, right in line with expectations. Although a big jump in CPI, not core, but in CPI from last month. That said, it actually brought down year over year core CPI slightly to I believe 5.5%. So basically 5.6%, excuse me. So this is important to kind of keep an eye on. Although that technically did drop, and it is 5.5. Although that technically did drop. This is a number that they're watching very closely in terms of where the interest rate is compared to where CPI is. And they focus more specifically on core CPI because that number takes out basically food and energy, right? So that's important to keep an eye on. Quite frankly, I think that this was, although it was in line with expectations, the core CPI is above the Fed rate. And that's something that they're keeping an eye on. So if that continues, June might be a little more up in the air than a lot of people think. All right. On top of that, we had today PPI come out at 0.2%, right in line with expectations as well. Again, a little bit of a drop from the year over year numbers, but that CPI number is really important. And then especially as we get later in the month, we'll get PCE numbers. That's going to be really important to watch as well. So coming up next week, we have retail sales and leading economic indicators, but we'll also touch on, we had a great question from Iris. We're going to touch on gold basically in this market environment and what that means and, how to consider gold and the different flavors of gold that you can explore in terms of investment strategies. So we will come to that next week. This week, though, the question is really around the debt ceiling. And I wanted to make sure to touch on that today because next Thursday we have our more full-length webinar. Today is not necessarily the vehicle to get too in-depth on the debt ceiling, but I did want to address it on a high level. And then next Thursday, I'll put the link in the comments below here as well. But next Thursday, we're going to really break this apart and talk about some more nuanced strategies. On a high level, debt ceiling question, right? What I will share on a very, very high level is that this is not anything that I think is unexpected. If you kind of go back to some of our conversations going back to late last year when we talked about a split between the House and the Senate, this was like this is just par for the course. When we have a House divided, you're going to get these arguments. It's a ton of political posturing on top of, a presidential election coming up next year. This is more than to be expected. I think that it's a scary headline and the media loves to cover this stuff. But in reality, I think it's going to be a lot of just fingers pointed, a lot of blaming the other side, a lot of, if only they would negotiate type of conversations on both ends. And likely they will come to a conclusion before we actually get to any big challenges. I can tell you that neither party wants to be responsible for a downgrade in our credit rating, right? That's maybe the best way to think about this. Now, all that said, I will be very clear that that doesn't mean we should ignore this, right? We should be thinking about it. We should be preparing in case something does happen. I just think that the chances are extremely unlikely that this doesn't get figured out. Or maybe better, I shouldn't say better, maybe more likely, the can just gets kicked down the road a little bit, right? This happened 4 years ago. This will happen again. This has happened a number of times in the past, number of years, and it won't be the last time. So it's very likely that they'll kick the can again till later in the year. Again, we'll see more political posturing. But here we are now. And I think it looks like maybe sometime in June or so is where this starts to get very, very serious. But again, I think both sides are going to hold their breath as long as they can. And eventually they'll come to a conclusion before this actually turns into anything. Nonetheless, we need to be prepared. And so again, we'll talk more about this in our session next Thursday at 5 p.m. But there are certainly some things that you may want to look at, especially with bonds and maturities and trying to time, around some of that to reduce your risk. It doesn't mean, I don't think it means you should completely throw out your strategy entirely on the debt ceiling, but I do think having some risk measurement in place for some of those positions could be really important. That way you are prepared in case the unlikely event does happen and we do, see something a little more serious here. So really good question. I want to thank Keith for sharing this here today. And certainly, if you guys have questions, let us know. Next week, again, we'll touch on a question from Iris about gold in your portfolios or, physical gold, how all that plays in. And we'll look forward to sharing a little bit more then. We will see you next Thursday at 3 p.m. In the meantime, enjoy this amazing weekend of sunshine here in the Pacific Northwest.